Good morning, colleagues. Time is short as always, so we'll get started so we have enough time for discussions and deliberations. Good morning. It's good to see everybody on our early Thursday morning. I hope you've had a good week so far at the forum, perhaps. My name is Julie Kofod, and I'm an Associate Vice President with the UN Foundation and the acting head of our New York office. Welcome to today's event at the 2026 SDG Investment Fair, Financing Sustainable Infrastructure Through Public-Private Partnerships, Appraisal, Structuring, and Delivery. We excel at very long titles at the UN, I must say, and this is a great one. We thank UN DESA and the Sustainable Infrastructure Foundation for their partnership for today's event. I look forward to this morning's workshop on public-private partnerships, where we will explore the value and complementarity of SOURCE and STAIRS in improving project preparedness and readiness and promoting alignment with the SDGs. Today's clinic gathers public and private actors to provide a space to engage with these two tools. We will share a goal to strengthen the impact of multilateral development bank funding, and we know that to do that, we must anchor our efforts in building durable, targeted public-private partnerships. It is projected that the world needs an estimated $94 trillion in infrastructure investments by 2040 to drive decarbonization, foster a circular economy, and support the global energy transition. We're familiar with navigating challenging financing environments at the UN, but this is indeed a staggering number. Sustainable infrastructure is one area where we can meaningfully reduce the gap between the system's ambition and action on mobilizing private finance. This morning, we will work towards that goal as we assess how SOURCE and STAIRS can structure and deploy blended finance more effectively. This workshop will help us drive implementation and follow-up on partnership commitments, working in strategic alignment with the private sector to maximize coherence, coordination, and impact. It's an opportunity to explore ideas, to test approaches, and deepen collaboration around the SDGs. We have a long-standing partnership with the SDG Investment Fair. Thank you for that. And we're honored to facilitate these conversations again this year and to collaborate with both old and new partners in the room. I look forward to meeting everyone. I will now pass the floor to Cedric Fenril at the Sustainable Infrastructure Foundation to deliver his remark. Thank you again and welcome.
Good morning, everybody, and thank you for being here today. Thank you also, UN DESA, for organizing this event and providing for this venue here and this occasion to discuss a very essential topic. Just last week at the World Bank spring meetings, the Global Infrastructure Facilities gave an estimation of how the infrastructure gap is, and they provided the number that is quite big, 1.5 trillion to bridge this gap. And it requires, of course, mobilizing capitals and also rethinking how we prepare and manage infrastructure projects. And by doing that and starting on this topic, the first step is to use the tool available today to build the project needed tomorrow. So I will mainly articulate the talk today around three main points. That's the first one being coordination, and we are all here from different organizations, countries, also MDBs, international organizations, and also bringing the point to interoperability and having clear access to data, which is key to take well-informed decision and to also remove the silos that are sometimes existing in governments, but also between public sector, private sector, and having this system that will enable to and provide frameworks to develop projects efficiently. Second point will be to also bring forward those projects to bankability. Very clear aspects that is needed so far. How to do this? Mainly focusing on risk clarity, so providing data again, and also helping governments to better structure their projects and providing clear risk allocation and defining precisely what makes project financeable. And the third point to bring forward a prerequisite for scale, which is standardization. So having consistent frameworks and process to reduce the time we spend on preparing project, to reduce transaction costs, and to enable more programmatic approach that can be replicated across different markets and geography. So with this, I will present you the source platform, of course, but it's not only about the source platform. It's mostly about synchronizing the stakeholders across the full project lifecycle and making these pipelines of sustainable infrastructure an achievable outcome for everybody. Thank you.
Hello, welcome everyone. My name is Callie Sidarius, and I'm with UN DESA. Thank you for joining us today, both in person and online. We have about 50 registrants online, so we welcome you all. First of all, I'd like to thank Julie and UN Foundation for your ongoing support, consistent throughout all of our fairs. So thank you very much, and we look forward to future collaboration and partnership. And thank you, Cedric, for your source platform and the ongoing collaboration with our STAIRS tool. So thank you. Capacity building and training has always been a key component of the SDG investment fair. Most of you are not aware because we work directly with the member states, but it's throughout the year. We provide project preparation assistance. We provide instructions on debt capital markets and other capacity building and training opportunities. So over the past year, we've done almost a dozen trainings throughout the year. And it's global. So today we will unpack what makes this a successful PPP. PPPs are the most powerful tools in a developer's toolbox because they do several things at once. First, they spread risk between partners so no single party is overexposed. Then they unlock private capital for projects that unfortunately public budgets alone cannot fund. And they also drive efficiency by giving private partners a long-term stake in the project, which means that after completion, the private partners are still have skin in the game, which is very important. Today, in addition to a very esteemed group of panelists, and member states will be contributing to this panel. And one of the key messages, we'd like to make this interactive. So if you have questions, please raise your hand. Don't be shy. This is a clinic. This is a workshop. We really want to get to the beef, really in the weeds. So if you have any questions, we have a fabulous group of panelists from legal, developers, and again, member states. We also have UN Women who will review their mainstreaming gender in infrastructure finance, which is a very interesting presentation, as well as UN DESA's self-assessment tool called STAIRS. So without further ado, I'm going to call our first panelist, Jared Joyce Schleimer from Bracewell, as well as his colleagues online. And we also have Nadan DESA from Force for Good. And the panel is what makes us a successful, sustainable infrastructure project. Thank you. Jared. Nadan, hello. Are you online?
Yeah, I'm here. Hi, guys. Hi, Jaron. How are you guys?
Hi, how are
Me-
you?
Good.
Thank you for taking the time to speak to us today. Force for Good has also been a very important partner of the SDG Investment Fair, and they have supported us in our capacity building efforts. So, Nadan, in your view, what makes a successful infrastructure project?
So, I mean, I think rather than speak about what are see, my background is as an investor. I've spent about 22 years as a private investor across primarily impact-focused projects in the emerging markets. And I think, rather than comment on what makes a successful infrastructure project, I think my area of expertise is primarily in terms of what us as investors are looking for when we get a project proposal, and how do we look at the success metrics of a particular project. I think first and foremost, we're looking for a clear articulation in terms of what the project offers in terms of three key areas, which is in terms of its commercial potential, the returns, the cost recovery, the financial dimension of it. Second is in terms of having a really clear, crystal clear understanding of what are the risks that we face. And third is in terms of the impact, right? So I think it's all whenever we look at any project, whether in infrastructure or other impact projects, we always look at it through the prism of these three areas, which is purely on a commercial basis, what is it capable of delivering? From a risk perspective, what are the risks that we face, whether at the project level or at the country level or at the international level? And third, what is the tangible impact that the project is going to create? I think if we have a clear understanding of these three things, then that starts then the process of us formulating, our thesis, whether or not we think the project is attractive, and so on. Obviously, whether the project itself is attractive, we usually find out only in hindsight. Yeah.
Okay, so bankability is a very important
Yeah.
criteria for you as an investor. And can you just tell us a little bit about some of the projects that you've worked on?
Yeah, sure. So I think from an infrastructure perspective, goes back a long way. I think about I'm based in Mumbai right now in India, and so one of the first things that I worked on when I came here in about 18 years ago, came back here from I was based in New York actually, where you guys are. I came back here about 18 years ago, and the first one that I worked on was rolling out telecom tower networks across rural areas of India. And it was basically an infrastructure project. I mean, effectively became an operating company, but it was really a small portfolio of about 200 towers that existed in one of the states in India, and we were looking to acquire those and scale that up across much of the country. Now, India itself was going through a telecom revolution at the time, and there were new operators coming in, private operators coming into the mix. The the execution challenges of operating in the Indian hinterland at that point were very, very different than what they are currently. The user dynamics were different. I think we had less than 50 million mobile subscribers at that point. We have about nearly 1.2 billion mobile subscribers today. And this in the scope of about 18 years or so. Energy access was a big problem because a lot of rural areas weren't connected, and so you had to think about how are you going to make sure your towers have 100% uptime when they're based in some rural part of the country. And we had to work on, do you get diesel generator sets? Now, diesel generator sets aren't the most best thing from an environmental perspective. So there's a positive impact, but there's an offsetting impact of those as well. And we had to look at, can you bring solar solutions in? But then if you bring solar solutions in, are they actually bankable? So there are a lot of considerations that go in once you get into the nitty-gritty of these things, right? So that's just one example, but yeah, lots and lots like that. Everything from industrials to power networks, power distribution, currently we're working on, we have something in our portfolio where we're helping roll out smart meters across the country, because obviously things have moved a bit in India over the last few years. And now we're looking at a large smart meter rollout over here, and so trying to see effective ways to do that.
So regulation and government policies do play an important role in
Yeah.
PPPs. How do you find working with government? Any tips for the audience? Because we have a lot of PPP agencies online. Any
Yeah.
tips?
I think in terms of working with governments, I would say the one thing that you really want to shoot for is predictability of what the policy environment will look like across the life cycle of your project. Because a lot of times, especially in emerging markets, which is where been my area of focus, new policies are introduced, but there's a fair degree of changes that happen to policy along the course of the life cycle of any particular project. So it's not just about understanding what the policy environment is currently when you are actually getting the project up and running, but also how it's likely to shape up, for the next X number of years as your project goes on, right? And there are lots and lots of examples of this. I mean, we're looking at, we currently have one of our investments is in an electric vehicle company right now. We invested about 2 years ago, and when we invested, the subsidy regime for electrical vehicles looked a lot different than it does today. There was nearly 30 or 40% of electric two-wheelers were subsidized 2 years ago when we invested. Currently, it's probably less than 5%, right? So getting some sense not just of what the current policy is, but how that's likely to evolve allows you to actually price that into your project or build that into your project plan. So that because a lot of times I think where people go wrong is they make assumptions around how either policy staying the same or becoming more favorable, when in fact actually the direction of travel tends to be that eventually the government wants projects to stand on their own feet, right?
Absolutely. And this is a nice segue for Jared and his team from Bracewell. Bracewell is a law firm that specializes in project finance. So Jared, hello, good morning. Thank you for joining us today.
Good morning. Callie, Glenn, you and as a team, thanks for having us back to present to the SDG Investment Fair Clinic. I'm Jared Joyce Schleimer. I'm a project finance lawyer at Bracewell. Around 250 of our lawyers focus on energy and infrastructure in Africa, Middle East, Europe, and the Americas. Sense for relevant experience, recently we've closed on financing for the 66 megawatt Poro Power 1 solar project to be constructed in Cote d'Ivoire. This involves the first green bond under the West African Economic Monetary Union framework. Also working on the 2 gigawatt Al Sadawi IPP in Saudi Arabia, 300 megawatt wind in Ethiopia, and I'm working on a financing for a clean fuels refinery in Brazil. I'm joined by my colleagues online, Gordon Stewart and Tom Jameson, who are sitting in London and presenting over Zoom, and Allison Houston here in New York. Gordon and Tom have extensive experience in project development and finance in sub-Saharan Africa and the Middle East. And each of you has in-depth knowledge of the difficulties of project development. I'd love to hear your war stories after our session, but suffice it to say, sometimes things do go right. And surely we can learn equally from the things that go right as from the things that go wrong. On that note, Gordon, I'll hand it over to you.
Hello. Hi. Is he online?
They may be under my link.
So it's nice to hear about things going right. You know, we all talk about things that go wrong and challenges, but sometimes, you're absolutely right. A good project has a lot of positive attributes to it. And maybe you can share one of your war stories of something that went right.
As opposed to technical difficulties we're having this morning.
Yes, well.
I'll share a couple thoughts then, while we try and bring them online. And they may be under the link under my name and not under their separate names, if that's one thing that may help. I wanted to comment that we understand there are many differences between countries, their governance policies, priorities, beliefs, some of which override the economic needs, and yet the policy enabling environment plays a key role in facilitating project development and attracting investment. One thing that we've seen work well across various transactions is having a dedicated government transactional team where governments have centralized functions for doing deals, and often having that knowledge, some repository for info, skill development, ideally a team that can take on the work of deal making and become expert at it and be engaged and responsive and help each other government agency with their transactions, can take a variety of different forms, whether it is its own agency or a government investment bank. However it looks, it leverages the learning that you all are doing here and exports that to other agencies to aid in deal structuring.
So a strong focal point is key for a successful project. And also, how about any blended finance or risk mitigation tools that could be used to help push a project forward?
I'll turn it to my partners.
Okay, okay.
Well, that's what they're presenting on.
That's what they're presenting on. Okay, there's a, not online. Okay, so we're just having some technical difficulties. And you know what? We can go back to them once they get online. Is that okay, Jared? That would be great. Well, thank you so much. And we look forward.
We'll come back to this.
We'll come back to this because that's the meat of
That's the
this.
meat of the presentation.
Perfect. Thank you so much.
All right, thanks.
Thank you. Next. Our next expert panelist is Clemente Deval. He is ex-CEO of FDN, and he's an international infrastructure markets and sustainable finance expert. Very pleased to have him with us today. Yes, please, Clemente. Derek, Clemente has a presentation.
Okay, so, well, the technical
Yes.
issues being addressed. Thanks, Kali. Thanks to the UN Foundation for the invitation. I mean, having heard a lot of have participated in several of the events during this week, blending finance has become now a big topic. I mean, but as I also heard, this has been there for quite a bit. I mean, and when I was finishing my stage in the FDN, which is a development bank focused on infrastructure, one of the things that really attracted me about SDGs is I started to get a lot of invitations to workshops. You know, Jeffrey Oppenheim, who was working in Systemic, was doing a big report on blending finance. And he was very interested in this case, in this project, because for him it was an interesting example of what you could do if you use smartly the government money, but if you combine it with many other things to really create a more programmatic or systematic approach, and that could really have a major impact. And so they wanted to hear about it, and that's how I started to get interested in how could I share some of my experience on the objective of achieving the SDGs. And that's how I've been gradually moving away from traditional PPP work into SDG, but trying to see if we can bring in the experience of programmatic approaches and using smartly the blending finance. I think I can, okay. So I'll put you a little bit on context. This is 2010. We have a new government. This new president was very committed to become OECD member. And when the OECD did the assessment, one of the most important obstacles that they identified for Colombia to become an OECD member was infrastructure. Colombia had a lot of good things, but had a very lousy infrastructure given the geography we had. So the government realized that they had to do a major revamp on its basic infrastructure, primarily roads, ports. But I would say road was the biggest obstacle to connect the main cities with the main ports. So the government decided to design a program of, at that point, $50 million, which for us was a major investment in infrastructure. Traditionally, governments had done 2-3 billion per in the quarter, in the 4-year program. Here, the idea was to do 4 times or 5 times more in a period of 8 years. So the government, and we had many common obstacles, and I think many of the countries that are participant here probably had the same kind of situations. The gap was huge. We had a huge gap. In the case of Colombia, the cost of construction, particularly roads, was very high because of we have 3 ranges. We have the Andes. So from going to one city to another city, you have to go down 1 or 2 ranges to go to the other one. So the cost, I mean, it's very different in Chile. It was very different in Peru. You know, when everything is flat, the cost here is 3 or 4 times more expensive to do roads, especially high standard roads, you know, 4 lanes, 5 lanes. So the cost was very high. We had a lot of bad examples of corruption on public works. So public works for the government was clearly not the route to achieve this. It was clear that it had to be, we had to involve private sector. Private sector had to come, not only because of the resources, but because of their capacity and the construction capacity to do this kind of high standard projects. Government had fiscal constraints, so we had to be smart on the use of the government money. And in terms of the financial markets, because the idea was to bring financial markets, the local ones, there was very few banks really doing project finance in the country. Big project finance had been done in energy in US dollars, so it had been international banks doing US dollars, but this was to be a program to be done in local currency. So it required local participants. So we had few banks, and the local capital market had really not gone into this kind of risk-taking profile. And the capacity building in the private sector and public sector was limited. So as you can see, there was a lot of obstacles to get this program rolling down. And that's, I think, the way we started to build it was first to establish the conditions, you know, the legal and institutional framework was the first thing, you know, to really have a first-year PPP regulatory framework. We had done many concession programs in the 90s with some success, but we had learned. So finally, when we came to this program, and that's why it's called 4G, it was the fourth generation of toll road programs. So we had already built a lot of knowledge on what was needed, you know, to do a very professional PPP. So we introduced and we launched the PPP framework in 2012. And one of the important things was to standardize, and that was a key important thing, and that's where we started to work with IFC. They were our advisors to design this standardized PPP contract, which was extremely important. And then the preparation of the pipeline of projects. So we were able to produce around 32 projects, $500 million each. So it was large program of big concessions. And so that was the first step. And then the second part was building institutional capacity. So we had to start training the private sector. I mean, the banks, the local banks. Project finance was not, we didn't really have high standards of project finance. And I would say project finance was a very important piece of the solution, because project finance gives you the discipline to analyze risks and how to transfer the risk to the entity that has the best capacity to deal with the risk. So the whole discipline of how you dissect a project and decide which risk can be taken by whom is a very important part of this recipe. So we spend a lot of time, you know, working with the international banks and the local banks, you know, agreeing on a project finance contract for this standardized PPP contract. And And that was also very important to attract big construction companies. We needed big construction companies. The local construction companies were not big enough to do this kind of large projects. So we had to attract, and they needed to see a good framework, and it had to be a good PPP framework combined with a good project finance standard. And I will say that then the other big piece of the solution was, how do you use blending to strengthen these PPPs and to strengthen this project finance design? And that's where we introduced two approaches. One was central government putting budget money to cover certain big risks that nobody could assume, like pre-construction risks or traffic risks. In this case, traffic was very important because of the geography. So the government offered to cover anything that came below certain threshold. So it eliminated the big part of the risks for the private sector. So there was a significant amount of budget money committed to provide the environment necessary to give the assurance that the risks were under control, the big risks, especially the risks that private sector could not assume. The other important thing, the other part of the blending came through the institution FDN, which was the bank that was created for this purpose. And it was a bank, that had a very particular governance, and I'll mention something about it, because in basically 2 years, it became a leader in terms of project finance in the country, even above the private sector banks. I mean, and that's not easy to do in a public institution unless you do something structurally profound like the work that we did there. But we also had to transform the PPP agency, which needed to have also high standards, and IFC and IDB and World Bank supported heavily that transformation of the agency. And the other one, which we did some transformation, not enough, I would have to say, was the environmental agency, which those three agencies were key, the PPP, the development institution, finance and development institution, and the environmental agency. Those were the three key institutions from the government that were key to develop. And so big transformation happened there. And I'm highlighting the development bank because the vision here was you needed an institution that could really catalyze the mobilization of resources. It was not to do crowding out, not like BNDES in Brazil, which unfortunately was a story of crowding out. This was from the beginning, and that's the reason why the IFC decided to support us, is because we were going to do crowding in. And basically we needed to analyze what was the major obstacles for the international banks, for the capital markets, local and international, to come into these projects, and then try to address each of those sources and try to promote and create instruments that will make those different sources to flow into the projects. So we started to design products that will address some of the concerns that these sources had in order to guarantee the mobilization of those resources. And we did we supported also regulatory changes because we understood what, for example, capital markets, we needed to have the pension funds to participate, but the regulation was a regulation, very conservative regulation that really didn't allow them to get engaged in assets that had some risk, even if it was a controlled risk, but it was a very conservative framework. So we had to work with the regulators to convince them that the projects were well structured, that risks were capped, and therefore that it was reasonable to allow institutional investors to participate for a certain kind of products. And I'll show a few of those that were key on that. So the bank initially, its initial role was to offer long-term debt. I mean, and that's, again, there was a blending element on that because the government provided some of the funding. So the FDN was able to leverage private funding and government funding and had a big base to be able to offer long-term funding. So we were able to provide financing up to 20 years, which was difficult for any commercial banks to go that far. But we were filling the gap, where the biggest needs were, and we were able to combine the different sources to have a good mix of maturities and risk takers. And there were some interesting elements. One of them was the liquidity guarantee. FDN developed a liquidity guarantee that basically eliminated some of the concerns that the markets still had in terms of those government commitments. The government had a big commitments in terms of covering certain risks. And so there was a concern, will the government have the budget on time and not affect the project? So we developed a product that basically cover any of those possible gaps through a liquidity guarantee. That allow from the beginning to issue bonds, in the international market, which was very relatively new to see project bonds going to the market, especially for the first projects. And we were able, with the support of Goldman Sachs, which was the structure of the bonds, we were able to do some of the first projects actually issue bonds supported with these liquidity guarantees. The other very interesting product that was developed was some debt funds, because we didn't have enough local commercial banks operating. We decided we have to create some special vehicles that could channel debt, long-term debt, using institutional money. So we created these debt funds. What FDN did was put some seed capital, but primarily get the people together, really get some of the best asset managers interested in creating the fund. We didn't want to be the ones managing them. We wanted to be the ones, promoting them. And we were able to basically create 4 debt funds. And out of we had 4, it was like having 4 new banks specialized in infrastructure. So for a market that was very concentrated in 2 or 3 players, having 4 new ones coming really started to give depth to the market and allow competition to happen and improve pricing, improve maturities. And that was very important to start giving more vibrancy to the project finance local markets. Another interesting approach we took was with international banks. Initially, international banks were worried that they didn't have local currency funding to provide local currency loans. So we said, okay, if you want to participate, we're going to give you the funding. We're going to give you the pesos. So you, as an international bank, can provide local currency using the funding that we provided. And we helped 3 banks, and we did 3 operations, providing that. Then after that, the market, the FX market started to provide alternatives, and they started to develop their own local currency synthetic products. But at the beginning, it was very important to give these kind of facilities. And finally, we also promoted equity in order to strengthen the constructors, putting equity. We with CDPQ, we put together a $1 billion private equity fund, to basically support the projects, where FDM created its own asset management company to manage the pension funds. So we were able to mobilize pension funds combined with the experience of CDPQ as an infrastructure equity provider. And that was another important part of the recipe. So, and you will ask, how could a government institution become so, and this wasn't a period of 2 or 3 years, became a leader, and a developer of all of these facilities. And it was largely because we were not a normal public development bank. We were in some way relatively unique. And that was because we brought in non-government shareholders into the institution. Nearly 20% of the capital was allocated to these non-government entities, being the IFC the lead one, because IFC provided in some way the assurance that the governance of this institution will not allow the institution to become sort of politicized, and that the decisions will be purely managing or using high standards of credit assignment. the institution operated like a private institution, but with a public mandate, which is an interesting combination because we had the standards. We were able to attract the right kind of people, from the private sector, even international. I brought a VP for project finance from Washington, who used to be in the Italian banks, project finance for many years. So we were able to create an institution that really had the skills, the knowledge in a very short period of time, and that is how we were able to become a leader of all those solutions. And I think not easy to replicate, but if there is a political will, that could happen. And the achievements was very fast. We started to do financial closings, and in basically 8 years, we have already mobilized. Well, I still say we. I still have this. It takes time to get it out. FDN has been able to help mobilize over $10 billion of this program. So for Colombia, that was something really we had not seen. But more important, we were able to transform a sector, an industry. I mean, the project finance became a mainstream, and this was high standards of project finance, standards that were international, compatible with international standards. So that's why international banks started to come, capital markets started to come, because they felt comfortable with the standards, that we were applying. And what was, as you can see, very interesting was the mix of sources. At the end, the last data that I had, from last year, nearly 34% of the funding is coming from international banks. International banks, before this, international banks were not participating in toll roads, in concessions in Colombia, because it was not something they would operate. But now they're funding 34% of the, and the institutional money, combining the debt funds with the bonds, adds to close to 20-something% as well. The local markets have also been participating, and FDN has been a major. So the possibility of mobilizing a huge amount of resources, but also diversifying the sources. And I think diversification was key because it was difficult to rely on one or two sources. You needed all the sources because of the size of the program was achieved. And so some few lessons, and I've been thinking a lot about this because how can we bring this kind of experience to the SDG agenda? When we see that we need trillions of funds to do the SDG investments, but you need to take a programmatic approach, at least in some sectors. I won't say all sectors make it easy, but some sectors can. If you take a programmatic approach, you standardize a lot of the process. You standardize a lot of not only the project generation, but also on the financing side, and that's key. And blending, if you use the blending correctly, if you're able to address some of the risks, especially the extreme risks, the government eliminates what they call the tails of the risks in many of these projects, then it's easier to attract private participants. If the private financiers see the quality of the projects, see that the extreme risks have been capped, and see the regulation is properly in place, they will come, and they will come in big size. And if you have the volume, you need to have volume. If you don't have a volume in terms of standardization of the project, it's difficult to do big mobilization, but you can do it. And I think this is a good case where if the design is proper, if the programmatic approach is taken, but you at the end, and I will highlight the last issue, capacity building in the governments is fundamental, because you need to have governments leading a lot of this effort, and you need to have the capacity in the governments to do it. If you don't have that capacity, it's going to be very difficult to achieve those kind of results. So I hope this case is a good case, that illustrates what you can do when there is a political will to do it.
Clemente, this was a perfect case. Thank you so much, because you highlighted the challenges and you gave us solutions. And we're at the SDG Fair, we're all about solutions. And there's a lot to unpack here, but because we have some time constraints and Bracewell's online, can we take Q&A a little bit later?
Sure.
Thank you. And Clemente will be here later today as well. But there's a lot to unpack. Standardization. Project finance gives you discipline to define risk. I like that. It's very powerful. So Derek, is Bracewell on the line? Go back.
Thanks for having us back again.
You're welcome. And I thought that what Clemente said about blended finance, maybe we could take that and maybe they can also highlight how contracts are very important as a tool, because you are lawyers and
We like to talk about contracts.
you love to talk about contracts. Oh, here they are. Thank you so much for joining us.
Wonderful.
Not at all. And apologies for the sort of technical issues at our end. We were in the meeting room, but it didn't work. But now here we are in one of our offices. So delighted to be with you, and thank you for taking the time. So assuming we're coming across loud and clear, we're going to touch on a case study and draw out some of the sort of pertinent points that came out of that, which is sort of relevant to this conversation. But I'll hand over to Gordon to start off with, and then come back to me.
So I guess touching on a number of themes that one of your earlier introductory speakers was talking about, as mentioned, we have a sort of strong background. Particular focus has been on power and energy infrastructure development in the sub-Saharan African continent. And whilst many outside of the sort of African projects market often wrongly assume that one of the principal difficulties in getting projects away is credit risk. In fact, African projects that achieve COD actually have a comparably lower default rate than a number of their OECD peers. However, the key theme that was noted earlier is the big differentiator with sustainable infrastructure projects in Africa and other regions is the amount of time taken between the commencement of the development work and the actual ability to go and reach COD. And in a competitive market for capital, for private capital in particular, the potential for speed of deployment and the associated reduction in transaction costs and frictions are one of the big drivers of attracting capital into those projects, and beyond, if you like, what's often sort of thought of as the simple metrics of tariff or notional IRR. I mean, in particular, and this is more on the sort of power side, but the energy transition as well has sort of brought the potential for much smaller projects, which whilst having a lower risk concentration, but does have a far greater potential to transact that sort of ratio transaction cost to capital deployed. And what we thought we would do is run through a couple of projects from sort of recent experience in sub-Saharan Africa to draw out some of the sort of key takeaways, I think, that can provide a more efficient timeline between that development work initiation and a project actually achieving COD.
So thank you, Gordon. So thinking about this idea around time and the time taken to get from initial development through to commercial operations, we've taken one case study, and this is a power station in Zambia. It's called the Mamba Power Station. And I don't want to spend too much time, in fact, very little time, on the details of the project itself, because by and large, what we're trying to do is draw out common themes which would be pertinent for a power project, a social infrastructure project, a civil infrastructure project across the region. But the interesting thing about Mamba is that whilst it's a 600 megawatt project, so it's pretty sizable by regional standards, and it's all privately financed. It was construction in two phases. There was an initial phase of 300 megawatts and a subsequent phase of 300 megawatts. And the initial phase took a number of years to get from development through to financial close and then commercial operations. Whereas the subsequent phase of 300 megawatts, so exactly the same size of plant to the first phase, was achieved in around 9 months between lenders being onboarded, contracts being negotiated, and getting through to financial close and onto commercial operation, or onto construction, for instance. So it was a much shorter period of time to get through to financial close and into construction of phase 2 than it was for phase 1. As we thought, it's quite a neat example to ask, well, why was it that phase 2 was just that much quicker to get to than it was the case in phase 1? And thinking that through, there are a handful of important points that probably lead to that scenario. The first one, and to go to the sort of question on stage, contracts. So obviously we spend our lives as lawyers looking at the finer detail of the words on the page, and what makes our lives easier, and to be frank, what makes a developer's life easier, is if the words on the page for the project, the key project contracts, are by and large the same as those that were negotiated for the previous project. And Mambo is an example of a number of processes, a number of countries where the government have taken a set of documents and which worked for the first project, and rather than being tempted to think about, well, if we just realign the risk profile in this way and make it a bit more favorable to us, or let's think about taking that clause out and putting this one in, as soon as you do that, you slow everything down. Whereas with Mamba, they took the first set of documents that worked for phase 1 and they carbon copied them basically for phase 2. And from a time perspective, there is nothing better than trying to retain the commercial and legal risk allocation that was achieved for a bankable project and take that to the next project along the line. And processes, for example, in South Africa, the REAP program, one of the reasons it's been so successful is because everyone knows what those documents say and no one is thinking about trying to renegotiate them. And there will be a time for any jurisdiction where documents become more favorable to the government agencies. But if you're being tempted to make those changes, you're probably doing it too soon. And that is a real lesson learned, and something that obviously we hold dear to our hearts as lawyers who are focused on these things in particular. But there are other, interesting sort of factors that weighed into the Mamba scenario. And very, very briefly, appreciate that time is short. What are they? Well, one is having counterparties in the government agencies utility which are empowered to make decisions. And also are keen to be involved, keen to be in the room, to lead those negotiations and get the documents, if they are being negotiated in the first instance, negotiated in a timely and efficient way, which makes the best use of everyone's time in the room. Secondly, a regulatory framework in country which is tailored towards encouraging investment. And that's everything from allowing foreign ownership, even if intermediaries of companies or special purpose vehicles in country, through to allowing equity to flow in, debt to flow in, and then debt and equity to flow back out again in a relatively seamless fashion. And so having a regulatory framework which allows for that rather than provides blocks and hindrances around that is, of course, obviously, but fundamentally critical to getting the project away in a timely manner. And then with that in mind, we're thinking about FX regimes. A number of jurisdictions come unstuck because the regime for converting and transferring local currency into dollars or euros or whatever the currency is that the loans are being paid under for that project, that any blocks on that process cause real problems for both the project in the longer term, but also nowadays, with banks increasingly aware of these issues, getting the project away in the first place. If the banks feel that they're not going to get their money out of the country easily, then you have a real problem. And banks are particularly, as are equity providers, particularly aware of this issue because it's been a real issue in a number of jurisdictions in the last 4 or 5 years. I can see that the microphone going up, so I don't know if there's an initial question there.
Unfortunately, we have time constraints, but I do see a lot of common themes, standardization, similar risks as we saw in Colombia, the FX. They made regulatory changes, standardizations of not only the government of the contracts but also the projects. So there is a lot of similarities between a project in Zambia and a project in Colombia. So there's lessons
Absolutely.
learned here. So
Yep.
thank you very much for taking the time to meet with us today, and we look forward to seeing you at other workshops.
Not at all. We look forward to being in New York.
Hopefully, that'll be lovely.
Thank you very much.
Thank you.
Thank you. Thank you so much. Thank you, Jared. Thank you, Bracewell. And now we have a country experience exchange. So may I invite Kefa Sita from the National Treasury of Economic Planning, Kenya. And I'm gonna butcher this, so please forgive me. My name is Calliope, so everybody butchers my name. Abdurrahma Hussein from the PPP unit in Djibouti. Can you please join us on stage? Hello, please.
Hello, good morning.
I'm sorry? Zambia. Oh, okay, I didn't have it on my, Mariah, would you mind? Are they online? Yeah, I think somebody from Zambia. Hello, thank you. I'm pleased to report that Zambia, Djibouti, Colombia in the past, Kenya, they've all presented at the SDG Investment Fair at one point or another. So thank you very much for being here. Thank you. And so really, this is just an informal session, just to talk to us about your country experiences, trying to put together PPPs, some of the challenges that you've faced, some of the solutions that you found were helpful. Where do you see it going in over the medium term, your projects?
I have a little speech.
Oh, you do?
Yeah. So it's an honor for me to speak before you today and present my country. Djibouti is near to Ethiopia. Our strategy priority in public-private partnership, it's aligned with our National Vision 2035. Our objective, it's clear, is to mobilize sustainable investment that will accelerate economic growth and strengthen resilience. In this context, we have identified 3 priorities for us, with which we have a strong potential and impact and return, is the energy, transport, and food security. In this energy sector, our country is endowed with exceptional and largely untapped natural resources, and we are highlighting 3 projects: the development of geothermal projects, providing clear, stable, and competitive energy, the launch of green hydrogen projects, position our country as the future player in the global energy transition. We have also the expansion of solar energy, projects that we meet growth while reducing our carbon emission. Regarding to the transport sector, we have identified critical projects to support economic growth. We have the bus rapid transit BRT system to modernize. We have also our secondary airport and also asphalt production plants. And for the area for food security, we are focusing on projects with a strong social and economic impact, the development of date palm plantation, the slaughterhouse, meeting an international sanitary standard. We also need a modern greenhouse agriculture, So these projects are not only for us investment opportunity, they are part of coherent, ambitious, and sustainable vision for our country. So we're looking for a partnership to invest in Djibouti and take all the opportunity, and we have made it a lot of pitch book to see all of the country, all of the projects, so we can share.
Yes, please do. That
Yeah.
would be lovely if you could
Yeah.
share with us the pitch book, because we
Great.
have some investors in the room, and we also obviously have the legal services and other impact investors, so online. So it would be great if you can share with us the pitch book and with
Will
your
do.
contact details. That would be lovely. Thank you. So Zambia.
Thank you so much.
Thank you so much. You presented on Tuesday at the Goals Lounge as well, and a very interesting project. And maybe you can share with us a little bit about the project and any of your experiences working with PPPs.
Thank you so much for clarifying, because I thought you wanted me to speak about PPPs more generally, and I was going to say I'm not the best person to do that. I do think one of the assistant directors from the PPP unit in Zambia is online, Dr. Mdende. I'm not too sure. If there's time, it would be good to get insights from him. I mean, just briefly to talk about PPPs, I mean, for Zambia, they've become really important, mainly because of obviously the debt issues we've had. So having more private sector involvement in terms of infrastructure development is really critical as a way of just relieving that fiscal pressure on the government. And so it's a strategy that we are really employing quite aggressively. New legal frameworks have been put in place to support the PPP framework, primarily trying to make it a bit more transparent in terms of how you identify projects, how you identify partners, the bidding process. And also speaking to capacity development that was discussed earlier, right? Ensuring that some level of preparatory work is done. So one of the requirements, for instance, is to ensure that there's a concept note that's been done. Some pre-feasibility studies have to be done as well to show at least that there is potential for the project to be viable, even as you head towards now trying to do the structuring, assigning risks, and getting to financial close. I mean, it's interesting for PPPs. We always say it's a catch-22, because on one hand, you want the private sector to bring in not just the capital, but the technical expertise. But on the other hand, you also need the government entity to have some level of expertise to be able to negotiate appropriately, to be able to ensure that the terms that you're getting into actually give you value. We have some experience of projects where, well, you would argue they could have been better negotiated in the sense of the concession period, the time it took to recover the investment. And so capacity building on the side of the government to ensure there's mutual benefit is really needed. Currently, there is a road, a dual carriageway that is being done. And it had some hiccups. So initially the cost was quite high, and then with the change in administration, a new concessionaire, I think, was brought on board. And with this particular project, we also see institutional financiers coming in, the pension institutions, to partly finance the project. So a lot of interesting projects. One that we're currently pushing is the digital transformation project. The one I pitched on Tuesday is a private project, so it's not a PPP, but the government is pushing for being able to fully digitalize all government services systems, and we are inviting the private sector to come in to help to. And here it's where it's a little bit different, because it's ICT related. So it's about designing, it's about financing, it's about configuring during deployment, maintaining the system to some degree. And what we're hoping to raise is about $465 million. It's a very ambitious countrywide project. In terms of the core infrastructure, we're looking at introducing some of the emerging technologies that many countries are now using. So artificial intelligence, how do we bring in blockchain? How do we bring in tracing and tracking mechanisms to minimize smuggling, counterfeit products? How do we digitalize all the payment systems, right? So that we can reduce or minimize revenue leakages and increase, revenue mobilization for the country, which is needed to fund, public investment, public investments. The benefits as well very much aligned with the SDG goals in the sense that as we digitalize, as we become more efficient, effective, more transparent, as we seal those leakages, more revenue, we reduce the cost of doing business for the private sector, attract more investment, and ultimately foster inclusive economic development, which means poverty reduction in terms of the SDG goals. Also, some of the benefits, it's really about increasing access to some of the social amenities which are critical: education, health, financing. How do we use innovations in technology to be able to do that? So this project is huge. The return on investment, very preliminary estimates, at over about 100%. More work needs to be done, preparatory work, to just really establish the full bankability of the project. But what has been done so far is indicative that it will be quite commercially viable and at the same time have significant impact. One thing to stress, I think, is we certainly acknowledge that being a very huge digital project, which is meant to integrate all government systems, the principles we want to employ is to ensure that there's privacy, that there's security, autonomy for Zambia as a country. But at the same time, all government processes will be channeled through this. So the private sector is assured of demand for the services, of user fees, being able to provide the revenue needed to recoup their investments. Let me end here. I've said a lot, but yeah.
This was fabulous. And again, going back to Colombia, the Colombia case, it took them several reiterations to get to where they are today. So it's a learning curve. And the same with Zambia, it's going to be a learning curve. And increasing transparency is huge. I mean, from a governance perspective, from a revenue perspective, there's so many benefits to your digital program, which was very, very pleased to see. If your colleague is online and would like to say a few words, that would be wonderful. No, no, I don't know. We have next time, absolutely. But there's a lot going on in both of these countries that we need to unpack. And we have a feedback session now with Bill Campbell from iSquare and Cedric from Source, and Adam, if he's still online, to provide some feedback on these projects. So. Is Nadan back online? You want to, yeah, we could just. Let's try this one.
Now, can you hear me?
Yes.
All right. Hi, I'm Bill Campbell. I'm from maybe I stand up?
Yes.
Just a minute. I'm
Bill, would you like
from an infrastructure fund called I² Capital. We are relatively new. We're about 14 years old. We have about $60 billion of assets under management globally, and we invest really across the infrastructure spectrum. We invest in energy projects, both renewable as well as thermal projects. We're big believers in gas as a transition fuel. Do that in a lot of projects, and I'll talk about one of them in a minute. We also do a lot of digital, both in the data center space as well as fiber cable, subsea cables, as well as domestic cables, territorial cables. We do lots of transportation and logistics. I want to say how much I admire Clemente's presentation. We have a lot of toll road experience ourselves, but I'm going to give you some examples where it's a little bit different perspective than we have. Clemente's job has been to create a very difficult, very challenging kind of projects. We have a very different kind of take. I want to focus on kind of some of the experiences of us as a private sector investor, which I think are quite different than some of the experiences that Clemente's trying to deal with. We also invest in environmental infrastructure such as waste management, sustainable water, things like that. So a very broad spectrum. We also do social infrastructure. We have, for example, in Taiwan, a whole series of daycare centers for grandma and grandpa. The parents drop off grandma and grandpa in the morning. They play mahjong and have a good time with their friends, and then get picked up in the evening and go back home and spend time with the grandchildren. So lots of interesting kind of projects. One of our key needs is really a reflection of our investors. Our investors are big pension funds and sovereign wealth funds, insurance companies, big institutional investors. They want to get their money back. And so we don't have forever money. We have time-limited money. We're typically a 10-year fund, but investors are really looking to get the money back in 6, 7 years, kind of outermost. And so if we have a project that has a 7, 10-year gestation period, it's just not going to work for us. We have to be able to get our money in. We can build a project. We can invest in it. But at a point, we have to start getting money back. And so as we go into projects, we're looking to see, one, does the project make commercial sense? We're looking at all the kind of commercial bankability points about it. We're looking at the risk points. We're looking at all the kind of points, that you would normally expect. But we're also looking very carefully, how do we get our money back out? Okay, and that is really fundamental. And so we tend to do, I would say, not the big gigantic projects like Kementi's describing. We do different kind of projects. And so one example I can give, which just I think gives a lot of reflection in terms of how we approach things. We invest in India very broadly in toll roads. We actually now have built up a portfolio of toll roads is probably close to 10,000 kilometers altogether. We're the largest owner of toll roads in India, other than the government. We started those out, though, by investing in a single, very broken, used toll road. And this is the difference in terms of kind of the giant project versus kind of what we're doing. We invested in a joint venture with the IFC. They put in 20% of the capital. We put in 80% of the capital. We have always worked very closely with the multilateral development banks like IFC, ADB, others. We work also with national development banks such as the US government, the Germans, others. We work with them very closely. But the idea of bringing IFC in alongside is because we needed some ability to build a relationship with the Indian government, with the regulators. Working with the World Bank provides a real political risk halo. We're not buying political risk insurance, but we like that political risk halo. It also gives us credibility with the government. If the IFC is working with us, then we must be okay people. The toll roads that we're buying, though, are old toll roads. They're broken down, 5-year-old toll roads that we're buying from the original concessionaires who don't have the money to do the major maintenance at about 5 years. And we come in and we put in the money. We have a team of highway experts, and the goal is to completely transform that toll road, because these are toll roads that are corrupt, terrible accident rates, don't function well, strikes against the toll road, villagers that are near the toll plazas almost every day. I mean, they're just a mess. We go in with a very clear action plan that is focused on, one, stakeholder relationships first and foremost. Building relationships with stakeholders is fundamental to what we have to do. And so we work with the IFC performance standards. We focus on SDGs. We work on all these kind of things to build core relationships with the stakeholders. So there's trucks run off the roads all the time into the villages. We've planted probably more than 1 million trees now, and we water them. And the key there is to build a barrier between the road and the villages so the trucks can't run off into the village. We put in water cisterns near the villages to collect water during the rainy season and give it to the villagers during the dry season, because they always run out of water. Put solar panels on top of the toll plazas to run the toll plazas so they're greener. And we use that to run vehicle recognition software, videos at the toll plazas. And so we eliminate what was one of the major problems with these roads was toll plaza leakage, money not going into the toll plaza that it's supposed to. We have eliminated that essentially. We also have extra power that we can use to create schools for the kids and the villagers nearby, where we teach them computer literacy, better English literacy. We give job training. We encourage villagers to come and work at the toll plazas. And so we have essentially eliminated the strikes. I was in Rajasthan a couple of years ago, and I met with a toll plaza manager, and I asked him how he liked, working for the company. He said, "Oh, sir, I love our company." I said, "Oh, that's great. Why?" And he said, "We're building the best road in India, maybe the best road in the world." And I said, "Wow, that's great. Why do you say that?" And he said, my village, everybody is so proud of me working here." And I said, "Why is that so much?" "We don't cheat. We don't cheat. We have the villagers back. They know that we protect them, so they protect us." So that key is building that kind of fundamental relationship. But at some point, we also have to be able to get out of this road. We lower the traffic accident rate. We raise the income. Little by little, IFC wants to exit. They're looking at this as a way to develop the country commercially, because getting a road that actually will get you from Delhi to Jaipur is really important, because the roads, I can tell you, used to take you 12 hours to do what is now probably a 2.5 or 3 hour trip, because the roads begin to work. Once you get it so that the income begins to come in, you can then get other investors to come in. So we now have Japanese investors, we have Middle East investors, IFC has exited, and now these roads have become mature. And in India, there's a wonderful kind of way of creating a liquid asset, is we can transfer these assets into what's called an INVIT, which is essentially a liquid fund, so that our investors can exit, but they can stay in if they want, in a liquid asset that they can buy and sell just like a stock. So the whole key, I think, from an investor like our point of view, public-private is crucial to the project's success. We would never have done this project without the IFC's involvement. But what's nice about it is we were able to make very fundamental changes in the way an asset like this operates, but at the same time, be able to see a clear path to exit. Okay, by selling to strategic investors, by selling to an INVIT, there's a lot of ways that we can exit. And I think so for an investor like us, whether it is a brownfield project like a toll road or just a greenfield project, we're always looking at a very limited time horizon. And so for large grand projects, they're largely hard for us to do because the time is too long unless there's been a lot of development done early on in the stage. The key message that I want to say here is there's enormous amounts of capital available, not just from funds like ours, but there's just tremendous amount of capital. But it's all about trying to figure out what are the time horizons for the investor. And I think lots of times we get approached by wonderful projects where people have no idea what the time horizon is, and they're just not investable for us. We invest in 70 countries. We are present. So it's not like we're not in emerging markets. We invest in some pretty funky places, but we're looking at investments where there is a real exit that we can plot out. And that's the kind of key message I would suggest here for all these projects, is develop projects where you can attract investors like us. It needs to be a clear, and we look at all the things everybody's talked about. The presentations have been amazing, but you've got to look at one, how do we get in? How do we build a relationship with all the key stakeholders? And finally, how do we get out?
Thank you, Bill. That was a lot. There was a lot there, and it's a great project and impacted a lot of the SDGs. So thank you for sharing that with us, and also the importance of having a strong timeline. That's critical, and bankability. Investors need to be repaid. So in a matter, I think that given our time constraints, Cedric, would you like to say something, feedback now, or go straight into the source platform? Yes, thank you. Thank you very much. Thank you.
Can you see my screen? Is it okay? I don't know. Okay, good. All right, so as you could hear, it's very easy to develop and implement infrastructure projects and meet the SDGs. So after this great presentation, you can all go back to your office and work on that, right? So yeah, the answer is clearly that we need tools that to facilitate all this process that were mentioned, implement this national PPP framework that can be a challenge when there are new regulations, how to make them adopted by the ministries, the contracting authorities, also the subnational level sometimes, how to also better take decision based on data, allocating the risks, and pushing and putting efforts on the projects that have a potential to then be bankable and financeable. So the MDBs that you see on the screen came together and realized that they were putting a lot of money and efforts and time and financing to develop systems in different countries, and that those systems costed a lot of money. They were sometimes not fully secured also in terms of cyber attacks, and that they were operating mainly in silos. So they came together and developed a public good that is called Source and that is delivered for government for free. And it's an online software that is global and that can adapt to each country framework, and that will support government along the way of developing a sustainable infrastructure and managing those projects and going through all the different steps that were mentioned by our panelists, including evaluating these projects against the international standards, and very important one that were mentioned today, the one from DESA, STAIRS. So let me introduce briefly what it is. We are a Swiss foundation, not-for-profit, based in Geneva. I'm head of development. And last year, we worked together with the World Bank under the G20 South Africa presidency to develop a practice guide to make basically a study of how government in the G20 and also globally collect, use, and work on infrastructure projects and have different ways of having this system put in place, and what were the challenges and how to better help them in this journey. So we have this practice guide that I will use to articulate three main topics. And also, very important thing, we are hosted under the United Nations UNICC, the International Computing Center, to guarantee data security, sovereignty, and to make sure that countries that are using the system benefit from the highest cybersecurity, because these data have a high value and they are very sensitive. So we had lots of experience and feedback from governments that have been hacked. So we really want to avoid this, and that's why we use also this hosting that guarantees data sustainability. So thanks for our governance and being our existence since 10 years. We have been recognized at the G20 since 2020, and also last year at the G7 for the PGII. Among the BRICS, like South Africa and Brazil are using Source, and also for the APEC. And along the way, we have been implementing Source in all the countries that you see in dark blue here on the map. So we have 16 countries today that use Source on all their project pipeline, meaning that we give them the keys of the software so they can developed their infrastructure projects and manage their pipelines and portfolio. And the ones that you see in light blue are the ones where we are working currently. So we provide technical assistance to adapt the software to the regulatory framework. And the one in green are the ones that submit interest. So all of this work is financed by MDBs or international organization and bilateral donors. So governments can have the software delivered for free to them and have a global platform which they can operate, collect best practices, and also having a system that is customized domestically. So as we know that one size fits all doesn't work, and each country has its own regulation, its own evaluation criteria that they use. We spent a year, more or less, to work with the country, mainly with the Ministry of Finance, the PPP unit, the Ministry of Public Work, and all the sectorial ministries to build up a workflow that facilitate the application of the new regulations and to make coordination really happening between the different institutions in the country, and having a system that is really interoperable, meaning that breaking the silos of data that can exist between those institutions and having a single process and also a single platform to exchange information. So we, of course, train also the people to use it at the end, and after that period, we give the key of the software to the government so they can use it, and we provide ongoing support. So on this part, what I could do is provide you a quick walkthrough of what the platform is and give you an overview of some key functionalities. I think, yeah, here. We can see, so it's an online software, meaning it's easily accessible on any web browser. That's facilitate also its adoption by many countries. And as you can see here on this login page, only the user that are registered have the access with their own role and permission to their secured and online environment. So here I'm going to use an example in Brazil. Here my name is Beta Test, so all the information is factious, it's just fake projects, but it's just for demonstration purposes. But imagine here I'm in the Ministry of Finance and I want to have a global view on my portfolio, same as when Clemente was working in Colombia. He wants to have a full overview of what is going on and what projects are in preparation currently or in operation among the different ministries. So here, that's the first key point of systematic data collection at the, each project level, and to have a centralized portfolio that I can track, filter. I can see some feeds also on which action I need to do, notification. I can have a dashboard of my project by size, sector, subsector, by also size of investments. I can see them on the map and manage my pipeline per project status. Also the delivery mode, whether it's traditional procurement, PPPs, and I can evaluate and see how many projects also comply with international regulation, and have an overview of how many projects also contribute to the SDG. So that's very central for the conversation we are having today. What are the positive quantitative contribution of this project to bring access to clean energy, clean water, also the gender aspects, the access to education, jobs creation, clean water, and climate action, of course. So that will also enable to bring some lessons learned, to have exchange of best practices. We have a community of users that can also build up on the different success happening in different countries and exchange this data and share with them. And all the software was developed based on their feedback. So creating a project is fairly easy in Source. You select, you enter a title, you select a sector and a subsector, you enter the description of the project, and with this, you can select among the 40 templates that we have created with the private sector. So we have all types of projects that can be created in source, and we'll give you technical guidance to work on this specific sector. So I will use this solar energy, solar array in Brazil, and now I'm going to switch from the portfolio now to enter in a project environment. So here you will see the general information, of course, what's the description of the project and what are the key technical support it receives, what is the contractual modality, and also here below the specific country timeline. So that's what we customize into the software. We sit down with the different institutions to build up a complete step-by-step guide based on the country regulation. So by selecting on the left the different country parameters, I will have different milestones and tasks to do based on here the Brazilian public initiated state legal framework supporting by BNDES and a contractual PPP law that will guide me as contracting authority to follow the first step and the first important thing to do, all the steps that is according and make sure that the project is prepared according to the country regulation. And then I can follow and see what decisions are taken and have a project team. So that's the second important aspect, to be able to collaborate with all the people involved in the project. And when you are in the Ministry of Finance, of course, you are not preparing the project. When you are in the Ministry of Transport, you are not approving the project or you're not monitoring the fiscal impact of the project. So you need a team. And here people can invite each other just by entering the email and assigning some rights to access different stage of the project and see specific information, edit, view, or not access. And you can even invite external consultants to work with you on the different steps. So with your team, you can then work on your process and assign all the task, actions, documents that needs to be done to the relevant people and make sure that everybody is accountable, that there is transparency and good coordination among the steps that are needed, and that you don't forget any key approvals that is delivered along the way. So that gives you a clear report. And very important part to help countries on preparing projects. Like the information is fragmented. You have, for example, on the PPP, you have the APMG PPP guide that was developed by the multilateral development banks. This is like the PPP Bible, let's say, but it's 1,000 pages. Maybe you guys have learned it, but it's really also difficult for newcomers to know what I need to collect for information, what type of thematic aspects I need to include in my project preparation. So we build up this project preparation guidance. As you can see, it's all multiple choices, closed answer, numerical answers. Why is that? Is first of all to collect standardized data and to be able to also guide with specific tooltips that are coming from either United Nations, OECD. We have also the performance standards from IFC that will come here along the way and that can collect data that can be then used to do quality checks and also to collect best practices and to replicate those projects later on and have all the decision focus, for example, on his legal aspects and maybe hire some legal consultants to work with him on the regulatory assessments. So no data is also a signal that maybe something is missing. So it's like kind of a checklist that countries can refer, access definition, and involve also multi-cultural and international teams. So it's translated in to the right party in the contract. In that case, if it's public, the system will give you the guidance that has been developed by the World Bank and that is accessible for specific sector here, in that case, the photovoltaic plants. And if the allocation is wrong, the system will raise an alert, and same for all consistency checks that we have here on environmental, economic. For example, if the minimum debt service cover ratio is not according to the standard market practice, it will raise an alert for the request assistance. For in that example, the IFC PPP transaction advisory services that can be invited also on the systems to provide assistance and to provide, for example, a team of consultants on the capacity building and the legal aspects.
Cedric, thank you very much. I'm sorry, time is of the essence at this point. But your model really thinks of every possible iteration that and really is helping the PPP
Just let me
units.
mention stairs at the end, and then
Okay.
I conclude with this.
Oh, okay.
Also, why these data are standardized, and that's something that was mentioned recently by FDN last week in DC. The teams is already struggling to develop good documentation, and then to apply to the different standards is lots of work and lots of data to compile. So using the standardized data UNEC peers and also the DESA stairs. So in one systems, you can evaluate your project against all international criteria if you wish as a government, and then and internationally. Here another example in Madagascar, the PPP unit has implemented source, they promote the project, Tanzania is here, and I leave you the floor if you have any question. Thank you.
Any questions?
Thank you. I have a question. This is great from a government point of view, but I know that from in a PPP, a private sector point of view, especially the project implementation timeline is controlled by the project developer, and which is often also the investor, and they're not going to want to share some of that data, and the government is not controlling, the implementation schedule. Sure, there'll be big, benchmarks you have to hit with the government, but how are you kind of managing
and decide who has access to what and can see which type of information. So that's very important, and the government is in control and can coordinate his work with the private sector if needed.
This is very impressive. I mean, you really thought of every possible challenge and for this platform. Thank you very much. May I introduce Glenn Hodes to talk a little bit about STAIRS?
To address kind of a different problematic for clients that we had, and then we saw this great potential to integrate that tool into the source platform, which, as you see, is absolutely amazing and comprehensive. And really the problematic that I think pipeline of bankable infrastructure projects, and they needed a very sort of quick screening and appraisal tool to help them understand called STAIRS. And it also addresses a fundamental market reality that I think Bill adequately addressed, which is that there's much capital on the sidelines, particularly in infrastructure where they call it dry powder reserves. That's not because there just isn't a sufficient quantity of investable projects. So STAIRS really tries to address that. And unfortunately, with the interest of time, we can't go through an online demonstration. But at your own leisure, we have the tool online. It's stairs.desa.un.org. And anyone can use it. It's a public aspects of the project itself. The second piece of it is the impact, which Bill also talked about, the importance of that, the alignment to the SDGs, the kind of safeguards and environmental and social criteria that are being followed in the project development. And then more on the investment attractiveness side, understanding the track record of the management team, the quality of how the project is designed. Obviously, another factor that's very important here is the credit worthiness of projects in terms of the quality of the cash flows, which is for most infrastructure projects, especially for debt, one of the most more in a conceptual stage and need to go back to the drawing board, let's say, for more advanced work. But if you do go on, there's the full questionnaire that you complete, and we've done this piloting with several countries, and it really can take as little as 30 to 40 minutes to go through the questionnaire to get a quick sense of the stages of the project. So I won't go too much through the methodology because in the interest of time, but just to say all of these criteria and questions do have a kind of weighted approach to normalize the scoring into five levels. And that basically runs from the first level, which is kind of a conceptual ideation stage, all the way through to what we would categorize as kind of a bankable, investable the result of the project that you've put through the analysis in terms of the actual result compared to the optimal score you would get for each of those different aspects. So even within the broad pillar, there are 4 or 5 key sub factors that are weighted. And then actually you get a report, and the report, what's nice about it is we've kind of developed an algorithm, so the report gives you 4 or 5 key recommendations, which hones in through a gap analysis on which are the most critical areas to focus on to further advance the project towards investment readiness. And so we're very excited, and we have piloted this our main sort of client. So thank you so much. We hope you will continue to explore and use this tool, and we're really excited to see the next phase of this work, which is fully integrating it into this first platform. Thank you.
Thank you very much, Glenn. And if anyone wants an online demonstration, we can always arrange it with one of the DESA team members. So you can, may I present? Talk about their gender tool. Thank you.
Thank you so much, Kelly, and good morning, everybody. I'm pleasure to be part of this discussion. And as the last presenter, I'm also joined by my Chief of Economic Empowerment section, AI, Robin Oates, who is sitting back the room. And thank you very much for joining me as well. Women as an organization working for gender equality and women's empowerment has been involved in the investment conversation. Actually, our sustainable finance work has been started within the organization since around 2019, and we have supported our partner to integrate gender consideration into their financial strategy, their policy reform, and also their market practices. Regarding infrastructure, last year we worked with Asia Infrastructure Development Investment Bank to develop guidance to advance care infrastructure finance, which is traditionally under-recognized area, but we have seen great potential for investment. And also for this, these tools that we are mainstreaming gender into the infrastructure finance. So. Their daily journey is more complex, combining from school to health center to early care and or children care center, from the grocery shopping local market to the laundry. So if the public sector or public transport is not designed without considering these efforts and patterns, women can be easily exclusive from the system, and the cost for timing and also the cost for commute mobility will be increased. So that's why we believe that infrastructure is a long-term, is structural. If gender is not considered, all this inequality issue will be locked in. So our guide is designed for the project owner who is seeking for the development finance funding, especially from the Multilateral Development Bank and Blended Finance Solution. So I believe this perfectly fit into today's discussion. And a common question is, well, it's easily we can see that, and for example, for the private sector and the financial institution, gender is linked to the financial sense. like if the infrastructure doesn't take gender needs into account, maybe the building and the facility, they will miss the opportunity for women users to use them and access them, and accordingly, the revenue generation will be decreased and missed. So that's the economic sense that we want to convince investor and project owner to buy it and to consider it better. So our guide basically transfer the gender equality as from a social objective to a more driver of sustainable investment. So basically, our guide is stressing 3 challenges that investor and also the project owner but it's not very easy to be navigated, even though they are not contradicted to each other. And also the implementing capacity gap that project owner, they cannot cap very fast rapidly evolving criteria from all these financier, and we are providing more downstream technical support. How we reframe gender equality, not just as a response to the inequality and vulnerability, but an economic issue. So we basically put gender into the project fundamental. We talk about gender risk and gender return, and also gender performance that link to the project economic opportunity. For example, gender-related risk about community opposition, safety issues, safety concern, and exclusion concern, they might directly lead to the project income generation perspective. So we consider them into the financing structuring and also introducing the innovative instrument like gender bonds, impact fund, and blended finance to put gender KPI into your financial terms. For example, to consider how to incentivize the investment and also the return through monitoring the reduced time for water collection for women. So regarding the methodology, I will skip all the details, but really highlight key 3 aspects. The first one is we provide a life cycle checklist. For each step of the whole project life cycle, we give a list of checklists to help you to identify where is gender relevant, how you address gender, and how you make gender impact. The second part is we don't only do the safeguard and avoid risk, but also helping you to consider how to make your project more indicator for KPI and monitoring and evaluation, and also do your adaptive management response after all your evaluation. So it's a lot of practical toolkits and assessment and templates, terms of reference that you can borrow, you can learn, and it will support you to really transfer the your action plan, your commitment, gender equality through the sustainable infrastructure into the action. So we are still working in progress, and there will be a lot of refinement to be happening, and we will take piloting training and also the consultation session through this one for our further refinement. So if that is of your interest, we are very happy to collaborate. So let me pause here. Sorry for the very squeezed presentation, but thank you very much.
So much. And the presentation is excellent, and we're very happy to share it with you all, as well as their contact details. It's very well thought out. And so because we're over time, I'd like to thank everyone for joining us today. There's a lot to discuss: standardization, harmonization, regulatory, even contracts. There's just there were a lot of really interesting topics, but I think we will need to adjourn. But at I'm sorry, now I'm losing my track of time. 3 o'clock, digital transformation conference rooms 12 at the Secretariat. We're having a very interesting panel discussion on digital transformation, and we invite you all to attend. Thank you.